Hi. In today's lecture, we're going to be going over DuPont analysis. Now, don't let the fancy name intimidate you. You're going to find that it's a very simple procedure involving some very rudimentary kind of math abilities. Again, something that you'll be able to master. But what does DuPont analysis do? Well, it takes that return on equity, which is, if you remember through the readings, is very essential. It really tells you how much within an organization equity, okay, equity, which is the ownership component, what is really owned within a company, and how is that ownership used to produce revenue generally or net income? How efficient is that equity being used? And that's when you think about it, when you go down to what is it really all about? It's about how that chunk of ownership in an organization is used to produce more stuff. In this case, it's usually more money and revenues. And that's why ROE, which you will hear quite frequently, is such an important number. But within that ROE, it can be broken down. It can be deconstructed into various elements that can tell somebody very quickly how they got to that number. Because there's different ways to get to that return on equity, and they're not all necessarily equal. And the DuPont equation will allow you to break that down and to figure out how that company got there and compare that. And that's generally what you want to do, is to compare that deconstructed ROE, and that's all DuPont analysis is, against other industry norms. So let's do like we always do, and I will walk you through an example that will hopefully illustrate the power of the DuPont analysis. So let's go to our magic blue graph paper and work through a problem.
All right, so let's take a look at this DuPont analysis. This originally came from the DuPont Corporation. Many of you are aware, hopefully you are aware of DuPont. I mean, they're a big chemical company, but they also have their hands in a lot of other things, but their foundation was on chemicals. And back in the 1920s, their analysts came up with this way of looking at ROE that we've used for, over almost, 90 years now. So a really kind of a powerful way to look at ROE. Now, I've set up some things here for you. We've got an income statement, a very basic one, but has all the elements. So we got our basic income statement. We also have a basic balance sheet that we're going to need to do in order to kind of walk through what this DuPont analysis is. Let's start off with this top equation here in yellow that you see at the very top, and how the elements of ROE and what we're eventually going to break these down into. And once you see the walkthrough, you'll say, that's it? It's that simple? Yeah, it's that simple. But ROE equals the total margin times the total asset turnover times something called the equity multiplier. Now, what do all those things mean? Well, basically what I've done down here is translated which each one of these elements mean in this part of the formula. Okay, so you can see each of their corresponding. So let's talk about them briefly for a moment and how they relate to each other. So let's talk about return on equity, the first part. That simply tells you how efficiently or what is being returned on the ownership component within an organization. Now we're going to bring back a little bit of accounting here. It's kind of hard to get away from that part. But if you remember from accounting that assets equals liabilities plus equity. That's an E, believe it or not. Let's erase that and get that a little bit better. So what that tells you is really the fundamental equation of a business entity, and kind of the foundation of accounting are these three little elements right here. Assets. Well, what are assets? That's the stuff. The building, the cash that might be on hand, the MRI machine, It could be your accounts receivable. Those things. Those are assets. Those are things that have a value to you. Okay, they're physical, usually physical, sometimes cash or securities, investments that you have within your organization. Again, so you guys remember, even hospital systems, they own millions and millions of dollars worth of usually of securities within their investment portfolios. All the big ones have these investment portfolios. But it's all the stuff that you physically see, and sometimes the cash and investments behind the scenes. Okay, so those are your assets. Your liabilities. Well, you guys know what liabilities are. Those are the loans, the debt of the organization. And debt is good when it's used appropriately. It's an essential element within finance. So the liabilities that you have there. And the equity, that's how much is left over for the owners, okay? If you see that the two sides of the equation, they have to balance. So, you have the assets equals the liabilities plus the equity. And if you flip it around, you could see that assets minus liabilities would equal equity. So equity is really what's left over, what is truly owned, free and clear, without any liabilities attached to it. And from a profit company, equity is typically stock owners, people that own stock. They're the owners of the company. If it's privately held, and some healthcare entities are privately held, for profit and privately held entities, it could be, again, what do the owners own within the company? Within a nonprofit, a little bit different, but it's the same. They just use different words. It might be retained earnings. It might be a change in account balances, but it's still the same thing. There is a kind of a quasi-equity component to it. Again, with nonprofits, they're not owned technically, but there is an analogous component to equity. Okay, so that's what is kind of the most important thing when you look at what is the return on my ownership, and that is when you're really looking at ROE, return on equity. What is my return on that ownership component within an organization? Important metric, but we need to strip out. We need to find out some other components within there. So the next piece that we're going to be looking at is when we deconstruct this ROE is total margin. Now, total margin is net income over total revenues. Net income, is really the bottom line. What is left over? Okay, you're doing procedures. Okay, let's say you're doing surgeries and whatnot. And what is left over after all of your expenses? That is net income. Okay, after you've included all your expenses. Most of you are pretty familiar with income statement sheets. It's kind of the bottom line. You might always hear that term, the bottom line. That's what it means. How is that different than total revenues, which is our denominator right here? I got that somewhat abbreviated here, but total revenues. How is that different? Total revenues is what you're receiving on the kind of the front end. So let's say a procedure for, making this up, for a knee replacement costs $10,000 for a single knee. And you're collecting from a third-party payer, an insurance company, $10,000. Well, it comes to make sense that out of that $10,000, you got to pay the nurses, you got to pay the doctor, you got to pay for the surgical implant, you got to pay for the anesthesiologist, you got to pay for the building, you got to pay for the lights, you got to pay for the liability insurance, you got to pay for a lot of things that's coming out of that $10,000. After you've accounted for all that, that's where you get net income. So net revenue is really what you receive on the front end, kind of the big, here's the check that you get, but then everything comes out of it. What does this number tell you if you're looking at total margin? If you have your net income over your total revenue, It really tells you how well are you managing your expenses. How much of that total revenue are you keeping to the bottom line? And if it's too low, if this ratio is too low, that means you're not you may not be, depending on each. This is where ratio analysis can sometimes not be always accurate. Or I should say, you should remember in looking at ratio analysis, it's good for comparisons. Not every industry is the same. So if you're looking at net income over revenue, you're going to come up with a number, and we'll calculate one here in just a second. But it will tell you really how much of your revenue you're preserving after your expenses. How well are you managing those expenses? That's important to know because there are industry averages on what you kind of need to retain kind of to the bottom line. The next item that we're going to look at is total asset turnover. This one tells you with the revenues that you're bringing in, okay, which remember it's different than net income, but with the revenues, with that initial big dollar figure that you're bringing in, how well is that being managed with the assets that you have? Do you have a lot of assets? Are you a very asset-intensive organization? That's important to know. Some aspects of healthcare are very asset-intensive. As I've mentioned in this course numerous times, medical imaging is kind of my wheelhouse. That in many areas within imaging is extremely asset-intensive, multi-million dollar pieces of equipment in there. So how are those assets being used to generate revenues? Are you doing that in an efficient manner? So that's an important thing. And then the last one is what we're going to call an equity multiplier. The best way to think of this is how leveraged is your organization? Now, you probably heard the term leveraged or highly leveraged, or you might have heard it on the news or even in movies, and especially about Wall Street, about leveraged buyouts. Leverage just means other people's money. Are you using a lot of other people's money, usually loans, to kind of run the activities of the business? So there are some organizations that are very highly leveraged, that have high percentages of other people's money, loans to make things go. Is that a bad thing? Well, that's up for debate. You got to be careful though, and you've always heard about highly leveraged. Again, some of these big, organization failures are because they were way too leveraged. And if any economic hiccup comes up where they can't make their loan payments, then things quickly spiral and go out of control. So it's important to know that. If you want to know, if you were just to look at the return on equity as a number, you would miss many of these key indicators that we've already looked at. So the DuPont equation or analysis is going to help us kind of break these down. All right, so let's take a look. Let's look at a real example. I've got, again, the sample income statement, a little sample balance sheet here, and let's see what this looks like. And it's not very difficult at all. What we're going to do is we're just going to put in our net income. We're going to start with the ROE. Here's the other thing, too, on this, is that you're just really setting up the equation. You're not going to actually solve it. And I'll show you why in just a moment. You really want to see the elements of the equation and what they equal, because that's what you're going to use kind of for comparison sakes with other organizations. So, all right, let me show you what we mean here. So with the first one, the ROE, say we're simply going to want to do this. Net income, well, let's see. Do we know what net income is? Yeah, we sure do. We got that right over here. That's $10,000. So we're going to put that right down there. Total equity. Well, we got our simple balance sheet over here, and we've got total equity listed right here. Okay, so we're just going to plug that in there. Okay, and that is, remember, that's our ROE. Boom, we've solved that. Next, we're going to find our total margin, which is net income Well, we already know that. We found that in our income statement. And that is 10,000. Divided by total revenue. We've got that right up here. That's 30,000. Remember, that's telling us how efficiently are we preserving, are we keeping the revenue? Is it all going towards expenses? That's not good. Of course, some of it's going to have to go to expenses, but the lower, or I should say, in this case, the higher, the better. You really want to preserve a lot of that net income down to the bottom line. So our next category is total asset turnover. How well are we using those assets? Are we too asset heavy? Are we managing our inventories correctly, or do we have huge bloated inventories with a bunch of stuff? Do we have a lot of equipment? Do we have 3 MRI machines sitting there that aren't constantly running 24/7? That kind of thing to generate revenues. Are we using our assets efficiently compared to other organizations in the generation of revenues? And that's what the asset turnover is going to be. Now let's see, total revenue. We know what that is. We've got that. That was 30,000. And then we have divided by total assets, which we know right from our balance sheet. And that's going to be 30,000. Just happened to be the same. There's no coincidence there. And then the next, we're going to look at that equity multiplier. Really, again, think of it as how much OPM, other people's money, are we using? And is that always a safe thing? Not normally, because if you hit some bad times, things go south really quick. And that's going to be our total assets. All the stuff we see, all the things, all the cash, all the stuff of the organization divided by the total equity. How much true ownership do we have of those assets? That's the way to think of it. Again, you can see here the company is, if you were to count all the stuff that you have, it would value at $30,000. If you were to count, what do I really own? I really only own $20,000 of that. So if you had let's say if the numerator and the denominator were both 30,000, well, that means you own it all. That means you would have no liabilities. Again, going back to the accounting equation here, where I'll draw a little dotted line right down there, but your total assets and equal your total liabilities plus your equity. So imagine if this was 0, that would be 30,000. You would own everything. There are some companies like that. Apple is they do have some debt, but they could pay it all off. So there are some organizations out there. Healthcare, not so much. You're going to find they're going to be issuing debt. They're going to be issuing bonds, usually to be able to I guess fund the assets of the organization. But this is really important here. This with our equity, the equity multiplier. Kind of a weird name, but just again think of it as a judgment call in other people's money. How leveraged is the organization? If it's at 1, the answer is 1, then you know that, hey, you got no debt. You're not using any, you have no liabilities. If it's at 0.01, you are super leveraged and you better be making your loan payments on time, because if you make one hiccup, you're sunk. But you would never know that by looking at the return on equity. You'd think everything's great. So this is why the DuPont analysis is really so cool. So our next step in DuPont analysis is simply breaking these numbers down just a little bit further. Easy math here, guys. It's just some division. 10,000 divided by 20,000 is going to be 0.50 or 50%, so that's our return on equity. The next one is 10,000 divided by 30,000. That's going to equal 0.33, or that's going to equal 33%. 30,000 divided by 30,000 is 1. And then our equity multiplier, or our leverage amount, is a 1.5. So, so that's really kind of one of the stopping points is right there with the DuPont analysis. This breaks down what each one of those areas mean. Again, this kind of going back to what we're all looking at here. The 50%, that's the return on equity. 33%, that is going to help you get, again, that total margin. What we're saying in this with 33% is that out of every dollar you generate, 33% makes its way, or 33 cents for every dollar makes its way to the bottom line. Not bad. Not bad. That's probably pretty good. The next item here is telling you how efficiently we're using those assets to generate revenue. More industry specific, but again, something to be aware of in comparing this with other industry averages. And this number here, again, telling us how leveraged the organization is. And I think I may have misspoken. Maybe I left off a decimal point. If you have an organization that is greater than 1, that is when you're going to have the use of other people's money. Okay, and in this case we have a 1.5. Let me say this correctly. 1.5. So again, a 1 would mean that your assets and your equity are exactly the same. Would you ever have a number that would be less than 1? Well, no, you really can't have a number less than 1. So it is because you could only have a number that is going to be greater than 1, because at 1 you're already at, I guess, perfect ownership. Okay, perfect ownership is, like I said, there's no debt. You have complete equity and assets, so it will never be less than 1. But the greater the number, that's when you really want to get, when you're getting concerned. Are you at a point, watch my decimal points, are you at a 5.0? Are you at, a 2.0? Where you're twice as leveraged in the organization. So these are all key indicators. Now there can be the next step where you can combine these two numbers together. These two numbers here actually turn out to be something. And what they are, it's return on assets. So you've got all, what's great about DuPont is that it has all the essentials in there. The return on the assets, ROA, and return on equity. Those are kind of two key things you want to know. This one, it just happens to, the way the math works is that it breaks it down. So you happen to know that these two are ROA. Now you may want to go ahead, and I would suggest that for any assignments that you might have, is just take it to the next step, which you'll want to do the 50% equals, leave this step, you need this number. This is critical. You want to keep this one, and then you'll often will leave this next one that I'm going to do here, which is simply calculating the ROA, which is the 0.33 or 33% times 1. Well, 1 times anything, as we know, is the same, so we'll leave that, times 1.5. And again, this number right here happens to be ROA. So we got our ROE, okay, right here. We've got our ROA, return on assets, and then we have the equity multiplier, or tells us the amount of leverage. So you want to use these breakdowns in the equation. You're not going to solve it, because if you did, guess what you're going to have? Well, let's just run through it real quick. Let's solve this equation right here, because I know you want to. You're like, wait a minute, we got this, it's an equation, let's solve it. Well, 0.33 times 1 times 1.5. Oh, well, guess what? It's going to equal 50%, just as it should, because all it is a breakdown of return on equity. The power of DuPont analysis is breaking it down, deconstructing the return on equity into these three elements in this step, okay? And then also just to provide an additional break, or kind of another breakdown with ROA combined in the second step. So you do want to have kind of 1 and 2 here, but you're not solving anything, you're just deconstructing it. Once you've done that, then you compare that with industry norms to help you in your analysis with an organization. All right, so that was DuPont analysis. Hopefully you didn't find it very hard. It's some very simple ratios and can give you a lot of information about a company in a very quick glance with really only 4 essential figures that are on there. Okay, hope you found this beneficial.